Having a good credit score is extremely important, whether you're applying to live in a house or an apartment, and perhaps your landlord is looking for someone with a higher score. Because after all, if a landlord has multiple people applying to live in his house, if you see someone with a lower score, perhaps they're not going to accept you to live there if they see you as a larger risk. Or perhaps you're just looking to receive a lower interest rate on a new house. And of course, the higher credit score that you have, the lower interest rate that you will receive. So the truth is, you can save thousands of dollars over the course of a loan by having a higher credit score and therefore receiving a lower interest rate. Take, for example, if you have a $300,000 house loan, let's say that you have a credit score of 630. At that credit score of 630, at that point, you may be receiving an interest rate of around 4.8%, give or take. And then on the flip side of things, let's say that you have a higher credit score, or perhaps someone else has a higher credit score. Let's say that you or someone else has a credit score of 750 or even higher, which is considered excellent. At that point, you may receive, for example, a rate of 3.5%. This means with a credit score of 630 and a 4.8% interest rate, not counting property tax, insurance, or other fees, of course, your payment would come in right around at $1,574 per month. Then on the contrary, if you had a 750 credit score and you received a rate of 3.5%, your payment would then just be $1,347. That's a difference of $227 every single month, $2,724 per year, and $81,720 over the course of a 30-year loan. So as you can see, having a good credit score is extremely important. That's why in this video, we'll be going over the biggest things you can start doing today to ensure that you're able to start building your credit. But before we dive into the top ways you can build your credit, let's first look at this graph of specific factors detailed by Experian, which will result in your FICO score. So as you can see here, the top factor is your payment history. That is at 35%. That is closely followed up by 30%. That's amounts owed. Then, of course, at 15%, we have your credit history, followed up by 10% of credit mix and 10% of new credit. So these are going to be the things that affect your credit score the most. So with this chart in mind, of course, the single most important thing that you can do is to make sure with any credit card or loan that you have right now, always pay on time. If you have a history of paying your bills on time, that's going to greatly benefit your credit score. At the same time, if you're constantly being reported for paying over 30 days late, you're going to see a pretty big decline in your score. So it's pretty much as simple as that. Pay on time, see an increase in your score. Not pay on time, most likely see a decline. Now, the second way to increase your score is in the amount owed, specifically your credit utilization ratio. How this is figured is to add up all of the balances on your credit card accounts and divide that number by your credit card limits. So for example, if you have a $100 balance on your only credit card and that particular credit card has a $1,000 credit limit, in that case, you have a 10% credit utilization ratio. Now, in general, you want to keep this ratio below 30% and even better, if possible, below 10%. If that seems impossible to do based on your spending habits or your current credit limit, you'll need to do one of two things. One, you'll need to ask for a credit limit increase. You'll need to call into your credit card company, say, hey, can we perhaps raise our credit limit from 1,000 up to say 2,000 or 3,000, or perhaps you can just apply online. Or the second thing that you can do is simply apply for another credit card. You'll be issued credit by them, and therefore that should improve your credit utilization ratio. And then of course, the third thing that you can do, if possible, is to simply spend less. Even if you pay your bill in full every single month, you could still see a lag in your score simply because of a higher utilization ratio. So it's definitely important to, once again, keep it below 30 or if possible, 10%. Now, the last way in this list, but still equally important, is the length of your credit history. Now, even though you really can't shortcut your way to a longer credit history, after all, this takes time. There's no time machines that we can get in and perhaps go 5 or 10 years down the road where we now have a credit card for 5 or 10 years. It would be nice if we did. This is something that is going to take time. Now, one thing you can do is to piggyback credit off of someone else. such as one of your parents or perhaps your family members. Now, let's say that you have one of your parents, for example, they add you as an authorized user on their credit card. Let's say that they had this particular credit card for 10 or 20 years, and then you're added as an authorized user. When that credit card goes to report to the credit bureaus, you're also going to be reporting to the credit bureau. So it's going to look like you also had this credit card for, let's say, 10 or 20 years, or however long they have it. So it's definitely going to positively impact you in that way. And not only will this increase your length of credit history in a positive way, but it can also impact your credit utilization in a positive way as well. Of course, if your parents use this card responsibly. Interestingly enough, there are some websites that actually sell this where you can piggyback off of someone's credit card. Let's say that I go on this site and I have a credit card for 15 years and I have a good credit history with them. There is a way that you can actually pay this website a certain amount of money, and then the website will give me a fraction of what they receive, and you're basically piggybacking off my credit. Now, this isn't something I would necessarily recommend you to do because it is borderline illegal, and credit card companies can shut down the primary user's account for doing this. But of course, if you have someone that you trust, perhaps your mom or dad, they have a good credit score and they have a good length of credit history with a particular credit card, and they feel comfortable adding you as an authorized user, I would definitely take advantage of that offer, just because that can raise your score 30 to 50 points or perhaps even more in some cases, so that would definitely help. Now, of course, for those of you without a credit card, building credit can certainly be a little bit more difficult. The first credit card is always going to be the hardest just because you're not able to get the credit cards that require higher credit scores. Think of like the Chase Freedom, the American Express cards, those higher cards by American Express that you always see. If you apply for those cards, you're most likely going to get denied just because you don't have any credit. Now, what I would do is I would recommend applying for a secured credit card, which is basically where you put down a refundable deposit, which then automatically becomes your credit limit. So you could put down a secure deposit of, say, $300. Then you'll have a credit limit of $300. Eventually, once you're paying your credit card off on time, you can then get moved up to a higher credit card, and then they'll send the $300 that you initially deposited back to you. So that's definitely one way to start building your credit, is to get a secured credit card. Now, one secured credit card that I really like is Discovered Secured Card, and that's because you can earn 2% cash back at gas stations and restaurants on up to $1,000 in combined purchases each quarter. And then, of course, on all other purchases, you'll be able to earn 1% cash back, which is really good because there are no other secured cards in the market that I know of, at least, that gives you any cash back. Most of these credit cards are very basic. You're not earning cash back. You're not really earning any rewards. Now, lastly, building credit certainly can take time, but if you put in the work, pay off your bills on time, and keep your credit utilization low, you will definitely see a difference over 1 to 2 years. Now remember, always use a credit card responsibly and think of it like a debit card. Make sure that you have the cash in the bank before you make any purchase. Before you go out and buy that new big screen TV that costs $1,000 or $2,000, make sure that you have the money in your bank account that you can pay off that transaction immediately. You can pay it off as soon as that charge hits your account. You do not want to be paying late. You don't want to be receiving interest. You always want to be paying on time and keeping that credit utilization low in order to build your credit score. But on that note, I'm going to go ahead and wrap up this video. If you found the content in this video helpful, I would greatly appreciate you giving this video a like, and let me know in the comment section below what you plan on doing to build your credit score. But until next time, I'll see you in the next video.